Morning, everyone. Welcome to this morning's edition of the NPC Markets Morning Call. It's the 9th of July. War on, risk off, as Trump says the Iran peace deal is over. And look, I mean, as per normal with Trump, the amount of flip flopping that's going on is quite within the same session. Realistically, he's come out and said that he doesn't think the war's going to start, and then it will start up again. And then just as the market shut, similar to yesterday, it came out and started a second round of attacks on Iran. So the single biggest source of intraday volatility is basically his social media tweets, which is not ideal, in the scheme of things. So Europe had a pretty steep loss overnight as well after hitting record highs the previous day. It had its steepest one-day drop since March. Didn't really have that AI cushion in it overall. We had the chip stocks sort of bounce back, but I think that's just general flow of hot money, trying to find a home. And but I think realistically, I mean, Nvidia sort of let it a little bit higher, and then Apple doing a deal with Broadcom as well was a little bit positive for those chip stocks. So after a bit of 14% rout over 4 days in that SOX index, we really did see we saw a 2% bounce, which isn't much really in the scheme of things. And as I say, largely led by Nvidia, which I think the Chinese government's allowing a very select few sort of buyers out of China to have access to some of these Nvidia GPUs, etc. So that was kind of positive news. But I mean, at the end of the day, that was never a massive play for Nvidia globally. Really, it was only ever going to increase revenue by a marginal amount, and China's I think that it's more a reflection that if China's allowing it, then they're probably they're fairly confident in their own tech as well, because they have been making pretty decent leaps. Particularly in DeepSeek's going to start making chips, their own chips fairly soon. They don't have the fab machines, but I mean, they're getting really close. I think this, this general Western feeling that China will never get there is really increasingly becoming a bit looking more like arrogance than actual reality. Like they don't just make crappy t-shirts and poorly manufactured crap anymore. Like these guys they're moving towards that more precision manufacturing, and it's probably only really a matter of time overall. The only thing genuinely stopping them is that ASML, that photolithographic, and with the 2 and 4 nanometer wafers and things like that, which look, even TSMC hasn't even really adopted on that 2 nm. It's only really Intel that's got that, and that's why Elon's pretty sure that's why Elon's buddied up with them and helping them out with their with their side to improve. So as you can see, really red across the board. We do have bank earnings next week starting up. But overall, it was just a broad rotation. So the Dow was down the most, and down about 1.2. The S&P was down 0.28. The Nasdaq was up slightly. The Russell was down, more cyclical as well. There were other things going on apart from the president. Just I think he held like 6 odd hours of press conferences or something today. Does love the sound of his own voice, I've got to say, and most of it absolute dribble, but it is what it is. The market just hangs on his every word, and his words really not that. You can't. It's very difficult because he's like, the war's not going to continue, and then 3 hours later he would have known that they were going to strike. So it makes it very hard for people to to get a proper idea. But look, we also had some Fed minutes out of the Fed, which was the first under Kevin Warsh. He pushed for immediate rate hikes. The committee was evenly split, and look, whether this is just gamesmanship or showmanship in terms of not trying to look like Trump's puppet and knowing that they weren't going to go, is a different matter altogether. No one will ever know that necessarily, but he and most of them saw inflation cooling on its own, and that's obviously war dependent. But most also saw scenarios where it stayed elevated. So what a absolute shining example of what sort of answer you get when you get a bunch of economists in a room. There was some global growth forecasts out from the IMF overnight as well. Doesn't really tend to affect markets in my experience. But global growth forecast around 3%, just because of the Middle Eastern trade risks, and expects 2027 rebound. And then the IMF actually cut Australia's growth outlook to 1.9%, and the economists saying it's helpful for that'll be helpful for the RBA's inflation fight. So, I mean, there is a fair bit going on overall. Look, oil was up around the $75 mark, and we've got a little bit of a jump back up in volatility overall. I think vol was up around about 15% last night, heading back towards that. Not really the 20 mark, but heading back towards the 20 mark. And we've obviously had a big spike there in volatility for European stocks as well. It has been, I mean, given what is actually going on, we've got war, we've got we've even had upside volatility, which is quite rare. Usually volatility happens to the downside. But I mean, the sheer parabolic move in those chip stocks, I mean, that's creating volatility. And then into stock and into sector, the index is incredibly calm compared to what the movements in the individual stocks and in the intersector movements. You can just see there's just a constant switch back and forth, and so I don't think the index volatility is really a reflection of how genuinely volatile things are out there in single stock land, and it's something to genuinely look out for. The dispersion at around all-time highs, and you've got fund managers as well in the US at their lowest levels of cash. Pretty much on record, certainly for the last decade. And the least amount, and there's a thing for those of you who are options minded, the put call ratio, which is puts being the downside coverage. There is the lowest level of put or downside coverage or downside insurance or a hedge. The lowest level of that coverage, on record essentially, and that low level of fund managers cash level means everyone's fully allocated. I think everyone's expecting a bumper earnings season after last earnings season. Personally, I see there being massive risks in this earnings season coming up, as investors just get really, really critical on, all of this spend and not a lot of result particularly for the hyperscalers. There's going to be consequences to that massive rally in the chip stocks because the people that are writing the checks are going to be, they were already getting criticized for their, their CapEx expansion. Didn't bother Meta though. I think they committed another $10 odd billion for a Canadian data center for AI infrastructure overnight. SpaceX or XAI, which is the same company, that bought Cursor, which is one of from all reports from all my sort of dev-minded friends and colleagues, says it's the best sort of coding app out there, or AI coding, and they've released a Grok AI model for a legal and finance task targeting Anthropic and OpenAI. So be interesting to see, and I've really noticed that they've made a couple of really good moves on that AI side, SpaceX. So they've actually started, because Elon was so clever at getting his stuff built out very quickly. So he's kind of got spare capacity. So he's not really, he's been renting it out to the likes of Anthropic, etc., and OpenAI in that absolutely gigantic data center in, I believe it's in Texas, I think, and I've got to say, as a very or as a user of most of the AI models, haven't really had much of a crack at the enterprise level of Gemini, but certainly the likes of Perplexity, Claude, and Grok is fast, and it's cheap as well, like compared to the likes of Perplexity, which is more of an orchestrator, which is multi-model. It's very expensive. Claude probably then comes in about second, and then like Grok's, you can get a lot done with Grok, and you're not spinning up like loads and loads of tokens. The more use cases from an enterprise level they can do, I think you're going to start to see people gravitating towards it. And he's got the infrastructure as well, and pulling about 90 odd million like rental fees in his data centers. So it's like they've got the advantage there. We Elon probably being one of the better and more commercial engineers in history. So these are bond yields. So look, we obviously as Iran's escalating, we're worried about the Hormuz and the traffic, obviously increasing inflation. We're obviously worried about memory chips and there's this like mad rush for the hyperscalers to build out these data centers, etc., pushing inflation. The RBA actually made a comment on it overnight, saying that data centers can bring inflation. And I think there was even a comment yesterday around the housing market where developers are leaving the Aussie housing market for builds because the cost of the build is actually more than the worth of the house. So these headline inflation numbers, there's a lot very conveniently taken out of them, and it's not the world's greatest reflection on the real cost of living versus versus what the inflation number says. And I think the OECD flagged Australia as having one of the worsening living standards results in terms of what you get for your dollar. At the end of the day, that's what happens when you push it like an asset bubble like housing, for 40 years, and then and increase the cost of living. Inflation damages the middle and lower class more than any rate hike could ever do that. And I do hope that short-term pain of higher interest rates is a very good move from the RBA. This is just an oil chart overall. We've seen it obviously bounce out of its lows here. That was the start of the war on Feb 28. So you've got traffic roughly averaging about at the lows 35% of the pre-war traffic. There was one day where they got to 70 odd vessels got through, and that was very much in isolation. And it was just a mad rush to get through. It was one of those initial days, and so we're really only maybe at an average of 40 to 50% of the amount of traffic, regular traffic, that was going through before the war. This to me seems like a wildly underpriced, and I think defense stocks as well are looking extraordinarily cheap. There's been a round of the NATO meetings, etc., and Trump's just really making the rest of the world pay, and they don't have the infrastructure, so they're going to have to start spending their own money. And you've seen, and if anyone who watched the podcast yesterday morning will see that most of those NATO countries are actually spending, they're targeting 2% of GDP, and a lot of them are spending 3 to 4%, anywhere up to 5%. I mean, poor old Poland, they've got to spend, because if the Ukraine thing goes on and Russia, like we're at the 4-year mark, they're the obvious next, realistically, and. They're and Putin really, from all reports, thinks his political career and legacy rests on him winning that war, and he's not giving up. So it's not this is not going away anytime soon, either in the Middle East or in Eastern Europe. So Gold and silver still, and platinum still a little bit under pressure, just on the basis of these bond yields heading higher. It's just a function of the fact that obviously gold, silver, platinum are stores of value, but they're not, and eventually an inflation hedge, quite well generally. But probably follow money supply a little bit more. But because they're not a yielding asset, when yields go up, they tend to be, people tend to go back to treasuries because they're getting that yield, and obviously they're quite safe. But we are seeing, and we do have a Fed chair now that it wants to reduce the balance sheet, so there'll be less QE as well. So that's probably not that great for gold. Whether he can actually do it or not, it's a completely different matter. So I think the US debt clock is getting really, really close, to that 40 odd trillion mark, and there will be, I'm sure, there will be, there'll be big headlines when that happens. We're currently, as it ticks over, and you can go to usdebtclock.org. We're at 39,423 billion. So, and just to give you an idea, go and have a look at that website. It's quite frightening how much that's, that continues to rapidly tick higher, and there's no end in sight for any of this spending from the US government either, and no fiscal discipline, etc. So I'm not entirely sure, what the plan is there, and judging by Trump's, movements in the last 6 months, I don't think there is a plan. Look, nothing much out today. We're largely fairly quiet, I would expect, for the rest of the week. Everyone's going to be waiting for earnings next week. Volumes are still very low. In terms of the ASX, I think we were down about 30 or 40 points leading into, leading into the day session. Not a lot on the corporate calendar, and I think there's some numbers out of China around about midday. But a lot going on. I personally think there is a wide-ranging number of things that are stacking up to see a knee-jerk shift to the downside, and if we, from our point of view, we're very happy to buy the index, but obviously buying the dip, using a look-back strategy over the course of the next sort of 3 to 6 months. And for those of you who are interested in structured products, we've got a 4-month short strategy coming up, so people can hedge their portfolio, which is very low cost, and sort of give you a little bit of sleep at night, sort of a little bit of sleep at night, just in case all of these things start to pile up on top of each other. If earnings is disappointing in the States, this index is in trouble, and particularly the Nasdaq with SpaceX, being that $1.75 trillion white whale that it makes next to no money. That thing could cost the Nasdaq index, now that it's been included, $500 billion on its own, let alone the rest of the stocks. So we did the halftime report in Bulls versus Bears last week. Myself and Kai Chen will be doing the podcast this week, we'll be just having a little bit of a talk, mainly around the risks that are coming up, and why you should be, you're better off being concerned now, and being planning ahead and being a little bit prepared, than reacting at the time when it's halfway down and making poor decisions. So tune into that. You can go to Spotify, YouTube, Apple Podcasts, iHeartRadio, whatever. Go and find it on your favorite platform, or go to mpcmarkets.com.au/podcast, and you'll be able to find both of those podcasts and subscribe today. You can get across what the risk going on and what's starting to stack up. But thanks for listening this morning, and we will speak again tomorrow.